All right, today we're putting on our detective hats and diving into the world of finance. We're going to give the global food giant Danone a full-on financial checkup, and we'll be using the legendary toolkit of none other than Warren Buffett. Let's see what the numbers are really telling us. You know that feeling, right? You open up a company's financial report, and it just feels impossible. It's like you're trying to read a completely different language with all these ratios and percentages. It can feel pretty overwhelming, but what if it didn't have to be? What if we could just cut through all that noise? Well, today, that's exactly what we're going to do. We're using a simple but really powerful checklist inspired by one of the greatest investors of all time to see what we can find out about a company you probably have in your fridge right now. So our subject today is Danone. Yep, the company behind all those yogurts and water brands we see every single day. And the tool we're using? A straightforward value investing checklist that gets right to what really matters. Okay, so our whole investigation really boils down to just 3 key steps. First, we'll check the performance record. Then we'll examine the financial foundation. And finally, we'll try to find the right price. It's all about figuring out if this is a great business, if it's built to last, and, the big one, can we buy it for a good deal? Let's get started. First things first, the performance record. Look, before we get into anything else, we have to ask the most basic question. Is this company actually any good at making money? This is clue number 1, and it's absolutely fundamental. To figure that out, we're going to use a little something called return on equity, or ROE. Just think of it like this. For every single dollar that shareholders have put into the company, how much profit does it spit out each year? It's a fantastic way to measure just how profitable a business is. And here we have it. Danone's number is 10.73%. So what that's telling us is that for every dollar shareholders have invested, the company is generating about 10.7 cents in profit. So, is that good? Well, a lot of value investors, folks who follow the Buffett playbook, are really on the hunt for companies with a consistent ROE of 15% or even higher. So, at just under 11%, Danone is definitely profitable, but it's not exactly knocking it out of the park. We're going to call this clue moderate. All right, let's move on to our second clue. I mean, a profitable company is great and all, but not if it's built on a shaky foundation or a mountain of debt. So now we gotta check for any cracks. And for this, we use the debt-to-equity ratio. It's actually super simple. It just compares how much money the company owes to how much it actually owns. It's kind of like looking at your own bank account, right? You wouldn't want your debt to be bigger than all your assets combined. Same thing goes for a business. And here's the number for Danone, 0.85. What this means is for every dollar of its own money, the company has about 85 cents of debt. And that is a really strong signal. Generally, a ratio under 1 is considered very healthy. It tells us that Danone isn't leaning too heavily on borrowed money to keep the lights on. So, this clue? It's pointing to a really solid, stable foundation. I like to see that. Okay, so far so good. We've got a reasonably profitable company, and it's on solid financial ground. But now we come to the most important clue of all, the one that separates a good company from a good investment, and that's the price. Because, let's be honest, even the best company on earth is a terrible investment if you pay too much for it. So this is the million-dollar question, isn't it? We've seen the performance, we've seen the stability, but is the price right? Is this thing on sale? Are we finding a hidden gem on the clearance rack? To figure this out, we turn to Buffett's absolute favorite concept, the margin of safety. All this is the difference between what a company is really worth, its fair value, and the price it's selling for on the market. The bigger that discount, the bigger your margin of safety, and the lower your risk. It's that simple. And wow, this is where our little investigation gets really interesting. According to one valuation model from our data, Danone's margin of safety is a massive 81.76%. Yeah, just let that sink in for a second. Now, it's super important to remember this number comes from one specific way of calculating value. But still, what it's suggesting is that the stock's true value could be way, way higher than what it's selling for today. An 81% potential discount? That is exactly the kind of clue that makes a value investor sit up and pay very close attention. Okay, the field work is done. We've gathered our 3 key clues: performance, foundation, and price. Now it's time to put it all together and see what the final verdict is. So here it is, the final report card. For strong performance, we're giving it a moderate grade. That ROE of around 11% is okay, but not amazing. For low financial risk, with its debt to equity at 0.85, that's a definite strong grade. And for a good value price, well, with that massive margin of safety, that gets a very strong. What this whole exercise really shows is the power of just having a simple checklist. It forces you to tune out all the noise, the scary headlines, the market hype, and just focus on the facts of the business. It's all about checking the facts, not the feelings. So there you have it. We just used a really simple framework to get a much clearer picture of a huge, complex company in just a few minutes. So my question to you is, now that you've seen the toolkit in action, which company are you going to investigate next?